Well, first of all, I think it's typically a good idea to bet against the IMF, and one of the reasons why I have that view is that it's probably the most political organization that I could think of within the field of macroeconomics. It takes a long while to turn around such a supertanker, and they've been banging the drum on inflation way too late. They did not foresee the inflation wave coming ahead of it by any means, and I don't think that it will be ahead of the disinflationary wave that we are now amidst. The reason why I'm getting increasingly confident in the so-called disinflation wave that I see for this year is that we get, I'd say, convincing evidence now that wage growth has peaked. And that is of great relevance to the more sticky component to the consumer basket that relates to services. Everything in the service sector is very wage dependent. And as soon as we get the first signs of abating wage growth, it should spill over to service inflation more or less immediately. And therefore, given the amount of focus that we have on service inflation right now, I'd say that this is the next surprise for most market participants, that the service inflation is now actually waning. Everybody agrees that inflation in commodities is waning. It's basically simple math by now, given that we measure inflation in commodities relative to a year ago, where we had that massive spike into the spring due to the invasion of Ukraine. It will be impossible to beat that on a year-over-year basis for inflation. And therefore, we also have disinflation in the price of goods across the board, across the globe. But the price of services is now also declining, I'd say, on a monthly basis, more or less, which is the game changer for the inflation outlook this year. What I feel the most, and why I also disagree with the big drop in the inflation outlook from the IMF in 2024, is that we now celebrate too early when it comes to this inflation battle. I've been saying this since late last summer, that as soon as we get a chance to celebrate declining inflation, we will take that chance and we will repeat the mistakes of the past. I think the incentive structure of a central bank is fairly straightforward. As soon as the public pressure is big enough, they will cave in to the demands of the public. We saw that last year after a few attempts to deem the inflation transitory. They turned around and started hiking interest rates to an extent that we haven't seen in decades, because it was suddenly what was asked by politicians. And now the tide is turning. You see a couple of very relevant US politicians asking the Fed to pause, as we now see layoffs across some of the most important sectors in the US, as we see signs of slowing demand, slowing growth. And as soon as that slowing demand becomes a little bit more broad-based across the US economy, I guess the whole Congress will ask the US Federal Reserve to pause, not least since we have a presidential election coming up in about 20 months' time or thereabout. And that is one of the things that we know, that the Federal Reserve is usually very reluctant to move in strongly in either direction ahead of a presidential election. So I think that is of relevance also when we discuss this inflation outlook. So if they decide to stop hiking as a consequence of politics meddling with their reaction function, I think it's something to worry about for the inflation outlook, say 12, 18 months down the road.
Yeah, great. And you've neatly outlined kind of your methodology and how you're thinking about inflation in general this year and next. But I spoke to Jens about this as well. With so much data out there, it's now, I think, critical more than ever to identify, good data points and bad data points, the ones that actually can be categorized as proper leading indicators and ones that is essentially just noise. Which leading indicators do you use to predict inflation or the trend of inflation?
So It depends a bit on the time horizon. For the relatively short-term outlook for inflation, I tend to like surveys asking companies for their price plans the most. The best survey out there is the so-called NFIB survey. It is a survey conducted among SMEs in the US, and you simply ask the SMEs whether they intend on hiking prices relative to the current price plans. And when you get a very uniform response from the SMEs, then it's typically a signal that you should expect inflation to accelerate. And right now, we have about net 20% of the SMEs saying that they will hike prices relative to current price plans. And that is not particularly high from a historical context. When you get net 50 or 60% saying that they will hike prices relative to their current price plans, it is something to worry about. But 20% net in that survey is roughly equal to 2-3% inflation, something thereabout. So typical inflation levels, right? That's essentially the signal we get from that survey right now. We just before we started recording here, we had the prices paid survey from the ISM Institute out as well. That is another relevant price gauge, at least for the manufacturing sector. It gives you a decent prediction of goods inflation 3-6 months down the road. But if we look for long-term inflation indicators, or rather medium-term inflation indicators with a lead of 9 to 12 months, then I essentially lean on liquidity-based indicators. So if we see a strong increase in the monetary base, if we see a strong increase in bank lending, I would consider those firm hints that inflation will increase with the time lag of 3 to 4 quarters. Right now, we see the opposite. So very weak developments in broad money measures such as M2, relatively weak developments in bank lending relative to a couple of months ago, still decent in a historical context, but slowing momentum in some of these broader money measures. And I think that it is of relevance for the medium-term outlook for inflation. If I look a bit further ahead, and I guess some people will accuse me of correlation sugarcoating, if that's a word. I tend to look at the Chinese credit cycle as the best leading indicator for inflation in the West, with, say, 1 to 2 years of lead. And I think the reason is that Chinese credit is the first sign of changing momentum in the commodity space. So when the Chinese credit cycle starts accelerating, you should expect the commodity cycle to accelerate after a while. And that will slowly but surely spill over to a lot of prices in the West. But it takes a while. And I mean, over the course of Q4 and into the early parts of 23, we've actually seen a decent pickup in lending in China, alongside the reopening of the entire economy. And that could be one reason, as well as the political backdrop I mentioned, to worry about inflation into 24. But it takes a while from the first signs of credit creation in China until we actually see it here.